Hey guys, Aaron from EK Financial Group. I've been fielding a few calls this week from clients concerned about the current market state and what's been happening. So I just want to send this message out. It's a bit of a clarity and hopefully a comfort message about what is going on and hopefully how we should be responding and acting at this point in time with share markets. So what I might do, I might bring up my screen because I've got something to show you and run through. So what I want to talk about and go through today is the All Ordinaries. So the All Ordinaries are obviously Australian share market. So what's this made up? This is made up of a bunch of companies in the Australian market here where we trade on them and depending on how they're going. So this up now for the All Ordinaries is the past 6 months. Now, as we can see, the last 6 months have had close to 10% come off the Australian share market. Now, what I've been telling clients that what you see in the media about this doom and gloom around the share markets and this coming off is don't 100% rely or correlate this back to your superannuation or your investments or your pension funds or whatever it might be, because this is if you invested 100% in the Australian share market, right? Yes, you'll be down probably about 10%. Now, majority of my clients are probably maybe balanced investor or something like that, where about 70% of your money is in growth assets, which are going to be, your shares, your property, whether overseas, international or Australian. So if the Australian share market's dropping about 10%, remember, if you're a balanced investor, about 30% of your portfolio is in Australian shares, all right? Another 30 is probably in international shares, and you've got some property in there, then you've got some defensive assets like cash and bonds. So yes, your super is most likely reduced as well in the last 6 months, similar to this chart, but not as probably severe as this, unless you invested all in Australian shares. Okay, that's number one thing to think about when you see at night on the media about the share markets. Look, yesterday we lost about nearly 4%, or 3.9% yesterday. Not a good day. Your super fund probably won't drop that 3% in that one day, right? But it would have a little reduction. So just keep that in mind, that don't correlate exactly what the media says to your own personal circumstances, because most likely it's not 100% accurate, all right? So that's the first message. Second one is to think about, so one is, all the media, or try not to take on that 100% in its merits of what they say. Think about your shares, super and pension accounts as you would your property, right? So if we have a look at what's been happening, if we go back in, let's look at 5 years in the share market. Now, we're still up 18% over 5 years in the Australian share market. That includes this nasty looking drop here, which was COVID, right? So that's from the end of February 2000 down to about, late March. So there's about a 4-week period where we lost probably 38% in the Australian share market. Now, shares fell as low as the Australian share market went down to 4,800 points, right? From as high as 7,200. Now, since then, we've had a big recovery, and we've gone back up to 7,800, so even above the peaks before COVID. And we've only just come off a little bit now. That 10%'s really washed it back to about that 6,800 points. All right, so we're still 2,000 points above the bottom where we were in March 2000 when COVID hit. Now, one thing to think about as well is we can't time the markets, because what the message was back then in March was to say, look, yes, this is not nice to see, right? A lot going on, move very fast down, like a rapid decline. But even the best economists in the world could not pick this, when the recovery was going to be, right? There was some economists out there that said, look, we'll wait until the market recovers, or not the market recovery, but this pandemic is over before we get back into the market, right? Now, we've probably still got this pandemic, but we've just care less about it, right? Because it's kind of like a flu now. Most of us have had it, and we get on with our day. Now, what we can see here, the pandemic's not over, but the money recovered really fast. So after 4 weeks, we all kind of got used to the fact of it, and markets started opening back up again and rallying pretty quickly. So what tends to happen is when you're really fearful and emotional and using your emotion to make a decision, not your head, and what we teach you just to stay the course and stick to your strategy, what will happen is you'll most likely probably get out somewhere here when it's just got too much for you and you're like, I can't take this anymore. The media is going nuts about it being the end of the world. I can't handle it. Let me out. So if we're as silly to let you go into cash, which we didn't, but if we let you go to cash here, what tends to happen is we don't know when this period is here. So what you've done is you're locked in that 30% loss straight away. You'll never get back, gone. Then what will happen is you'll start seeing this recovery. Sunshine will come out, rainbows. It'll start looking good again. Doom and gloom's gone. The media starts playing up that we're in a recovery stage. then you go, oh, look, I'm safe now, Aaron, let me buy back in and put me back into shares and back into my risk profile or strategy where I should have been. So if that's the case, and I didn't do this for anyone, but if that was the case, then what happens? You sold down here, you took a massive loss, you buy back up here when it's high again. That's what people tend to do. They buy when the market's high and there's lots of confidence. They stop buying and they sell when it's in this period. To make money is when you should be doubling down here, right? When the market is coming down, even if you're buying at different intervals on the way down, because rather than buying on the way up, you're buying it cheaper as it goes down, right? So the one thing is we can't time it, no one can, but the ones that, if they decided without advice that they went to cash, went back in, they're doing exactly the opposite of what we teach people and what we've been taught our whole lives. Same with property markets, right? You try and buy when the market's down, you sell at the peak, right? They've done the opposite. They've sold when the market's down and they've purchased back in at the peak. All right? So think about it as your home. Just say your house you get home tonight and you've gone for a walk, you've gone to work, you get home and there's a massive neon sign on your front door and it says your house price today, right? Then tomorrow there's a valuation on your house. Then the next day and the next day and the next day. You'll freak out more than you're freaking out with the shares, because I tell you now, if you looked at your house price 6 months ago, I bet you it's quite a bit higher and substantially up than what it is today. But what are you going to do? You don't do anything, right? You just hold in there, and if you are looking to sell, you probably wait for a bit of a recovery, right? So I want you to think about your shares, your super, your investments, your pension funds, whatever it is. Think about it as your house, right? You sell in the high, if you need to sell, that is, and you buy more when it's cheap. Okay, or you stick the course. You just let it go. You know your house goes up and down, but you go, look, I'm not selling anyway, so I don't care, just leave it. Well, super's the same thing, right? We're not selling, we're leaving it, right? Maybe pension accounts, we're taking income, so yeah, that's like selling, but you know, our clients are going to have enough cash position sitting there to hopefully weather the storm for the next 6, 12 months or whatever it might be for it to cover again. So what markets tend to do is, the markets are built up of lots of companies, right? So markets are forward looking. So markets are priced in already, all right, with the 10% that we've lost now in the last 6 months. Even the last, look at the last month is about 6%, 5 days about 7%. So when you look at the last 5 days, we're down 7, but over 6, it's 9. So there hasn't been too bad if you think about the last 6 months. It's really the last week that's killed us. That's really where it's been. So as quick as it goes down, as you can see here, we start getting recoveries again as well. Like, look at that there. So we don't know what's going to happen. I don't know what's going to happen in 3 months, 6 months, 12 months. But all I do know is we stick to long-term strategy. We'll be better off in the long run. So as I was saying before, what was I saying? I lost my train of thought. But what I was saying is we can't time the market. So we don't know when is a good time to buy or to sell. All right. So the idea is you should just keep accumulating. Keep allowing our money and assets to grow, because no one can get it right with time in the market. So 3 key messages around, don't let the media really get you too emotional with you. Your portfolio probably won't correlate exactly to what the media is saying at night time on the news about the share markets. Have some correlation, but not as severe as that. They're doing their job, right? They're selling media. That's the point of what they're trying to do, is make you scared about this stuff. Look back in COVID. Look at that massive recovery we had so quickly as well. Go back to GFC in 2008, 2009. We've had massive recovery since then. So think about your shares also and your investments as your property, right? If you're not in a position to sell because you're just accumulating and you're just living off your pension, well, just ignore it, right? It will come back up. Like if you're not selling your house tomorrow, today, in the next 3 years, you don't care about the price. All right, it's gone down, whatever, but I'm not selling. Think about that, number 2. And number 3, no one can time the market. No one can do it well. Not even the best economists in the world can do it. So if you expect me to be able to get you out of the market and get you back in, it's not going to happen. It's not my job. It's not no advisor's job to do that. And most likely we'll probably get it wrong. So the best course is to stay in, because as soon as you miss out on that 1 week, that massive gain right there, there's like about a week, 2 weeks of a huge recovery. You missed out on lots and lots of money coming back. So look, I hope this message today has given some clarity and confidence about the markets. Stay safe, happy investing. Reach out if you've still got any concerns, but speak soon. Be well. Thanks, guys.